presentation followed by a Q&A session. The usual housekeeping rules before we begin. During the presentation, all participants will be in listen-only mode. If you have a question, you can raise your hand and we'll prompt you to unmute yourself and ask your question. You can type your question in the chat box and we will read them out. With that, sir, over to you.
So thank you, Yusra, and good day, everyone. I'll just quickly walk you through the operational and financial landscape of MCB Bank Limited. So we are primarily a domestically domiciled bank operating 1,396 branches in the urban and rural splits of Pakistan, providing transaction and financial convenience to a large customer base of over 9.4 million customers. With reference to our branch expansion strategy, we are trying to open another 42 to 45 branches in the upcoming year. The strategy here remains that we will eye areas where there are strong business prospects, while on the other hand, consolidate areas where the business prospects have proven to be weak over a period of time. By plugging in the 305 branch network of our wholly owned subsidiary MCB Stomach, we operate one of the largest brick and mortar network in the country. From international presence, we have 5 retail licenses or branches operating in Sri Lanka, 2 wholesale branches operating in UAE, 1 in Dubai and 1 in Sharjah, and 1 offshore unit in Bahrain. We have very recently opened a representative office in UK to channel home remittance business to Pakistan, as this particular market continues to register itself as one of the major remittance corridors post Middle East and US. In terms of our customer base, we are proudly serving 9.4 million customers through our brick and mortar and digital channels. Our ATM fleet being registered as one of the highest cash dispensation on offers transactions as notified by OneLink. In terms of our digital penetration, I'm pleased to share that we have approximately 1.7 million registered users, out of which approximately more than 50% are financially active. And by that, I'm referring to people conducting or customers conducting transactions in the last 30 days, a financial transaction. In terms of market share, we hold 5.6% share of domestic deposits as of September 30th. On the advances side, our share has dropped to 4.72. We remain a key player on the home remittance side with a share of 11.46. Now, moving on to the next slide, key macroeconomic outlook. So from a global perspective, the first 9 months were marred by uncertainty, primarily on account of the escalation of tariff and trade barriers, to which the markets have reacted strongly during the course of this particular year. From Pakistan's perspective, it has been considerable improvement on the economic front, with strong buildup of the external and fiscal buffers. Inflationary pressures did recede down to 2.3 or approximately 3 in August, have scaled up very recently to 5.6 for the month of September and 6.2% for the month of October, citing the issues on the food inflation and the trailing effects of the floodings that the country experienced. Current account deficit has widened in the third quarter, imports outpacing the export number. It sums up to $594 million, up from $502 reported for the same period last year. From a future outlook perspective, we remain cautiously optimistic. Policy consistency, agreement on the reform agenda that we have signed, it's already there, but we need to deliver on all the fronts with the global lender. Prime concern as of now has been the law and order situation and non-escalation. That remains a prereq of the tensions that we have with our neighboring countries. So from MCB's perspective, the key highlight for the 9 months period has been the current approximately 270% of the increase that we see on low cost or no cost deposit mobilization. Our domestic cost of funds reduced from 10.47 in the same period last year to 5.01 for the 9 months period 2025. And obviously it correlates with the significant decrease on the interest rate side. Standalone PBT of 87.5, with consolidated PBT of approximately 95 billion, reflects a drop of 8.7%. In terms of NIP, we have recovered close to 523 million in the 9 months period, which takes our total recovery to over 11 billion in the span of approximately 8 years now. Remittance business, as I shared earlier, remains a key business area for us. Not only it helps us on the fee side, but primarily the FX liquidity, which we can use to build more stronger relationships with the corporate portfolios. On the statement of financial position side, the asset base of MCB was reported at 3.2 trillion, reflects a growth of 529 billion when mapped against 2024 numbers. On the asset mix side, you would observe that the gross advances reflect a drop of 414 billion, primarily on account of the ADR based pressures receding as of December 31st, 2024. A corresponding increase is observed on the investment base, up by 843 billion rupees. Much of it coming in the floating rate segment, 520 billion added in the floating rate PIB portfolio, taking the base to 1.2 trillion. 218 billion addition in the fixed rate PIBs, whereas 72 billion were added in the treasury bill portfolio. The yield on investment is at around 12.57 in the 9 months period, as opposed to 19.35 in the corresponding period last year. In terms of our fixed rate PIB maturity, the weighted average yield to maturity is 2.9 years. On the liability side, we reported a deposit base of 2.231 trillion, a growth of 309 billion in absolute terms, out of which the current account increase was 272 billion, which is approximately 88% of the total increase in the deposit base, bringing us near to what we guided to the market in terms of concentration levels. So I'm pleased to report that we have achieved the 55% concentration level that we were eyeing for the shorter term. On the saving account side, we have added 35 billion rupees, 960 billion base as of September. So our total CASA base of over 97% as of September 30th. Equity base of 239, an increase of 12 billion rupees when mapped against year-end 2024. Moving on to the advances side, advances base of 680 billion, much of it concentrated in the corporate segment to the tune of approximately 500 billion rupees, which is almost 73-74% concentration held. One key area where we have seen improvement is the consumer segment, which is directly linked with the improvement in the macroeconomic environment, particularly the decrease in interest rate. And the segment where we are registering this particular improvement is the auto financing side. So our consumer banking group, our consumer lending portfolio is up by 9.4 billion rupees to 46.6 billion rupees. On the NPL side, based on the strong recovery produced by our recovery teams, we were able to reduce our NPL base from 53.5 to 50 billion rupees, a reduction of 3.5 billion rupees. Much of it coming in the loss categorized loans, which went down by 2.1, followed by a reduction of 1.4 billion rupees in the doubtful category. So the guidance to the market on the NPL side is that based on the credit due diligence that we have conducted, we don't expect any significant accretion in our NPL base going forward. There would be some classifications which are a normalized kind of a level that we have seen in the past. In terms of gross advances, if we take last 6-year period, the CAGR works out at 4.11. Advances yield have dropped from 18.15 for September 24 to 10.88, primarily reflective of the significant impact of monetary easing cycle reflected on the yields. As far as recovery from NIB is concerned, we have recovered 523 million for the year to date, taking our total recovery from ex-NIB portfolio of 29.6 billion to 11.11 billion, which is approximately 36% recovery within a span of 8 years. Investment side, treasury bills a base of 148 billion rupees, an increase of 72, PIBs an increase of 218 billion, taking our base to 469 billion. The significant increase was in the floating rate bonds, which are up by 520 billion to 1.2 trillion rupees. Another major addition would be in the shares in listed and unlisted securities, which is up by 4.7 billion per 12% growth. So prime areas where we have had exposures is energy, oil, and banks. In terms of surplus on revaluation of securities, you would observe an increase of 31 billion rupees, which is 198%. So the surplus on revaluation of securities has scaled up to 46.7 billion rupees, out of which approximately 20 billion relates to the equity portfolio and the balancing is related to the PIB portfolio. In terms of concentration levels, treasury bills constitute 8%, PIBs, fixed and floating added constitute 85% of the total investment base. And in terms of concentration within the PIB segment, floaters are 72%, whereas 28% is the fixed rate bond, 469 billion being the total base. So on the deposit side, total deposit base of 2.2 trillion with current account base of 1.2 trillion. So saving account base of 960 billion rupees. So that takes our CASA to over 97.5%. So primarily the strategy behind mobilization of current account is that first and foremost, the improvement in service quality. There are different methods, different parameters being introduced during the course of this year to ensure that we are able to provide service to our customers and able to generate or mobilize more current accounts on that. Apart from that, deepening of the existing relationship, activation of dormant relationships, and capitalization on the remittances flows have been in play to make sure that we achieve the target that we guided the market. So COD domestic is 5.01, market share is 5.68. If you look at the charts at the right, total deposit CAGR of 12.31 over the last 5 years. With this current account CAGR is 20.09, so outperforming the total deposit growth. If you look at the increase year on year, this is by far the highest that we have achieved. The latest was back in 2023, where we added 191 million in absolute term to the base, whereas for the 9 months, we have added 272 million current account to the base. If you look at the concentration levels, it was 49% current account concentration as of December 31st, 2024, and which has scaled up to 55% as of September 30th, 2025. Now, moving on to the performance numbers, gross markup income of 220 billion rupees reflects a drop of 63 billion. Markup expense, a positive variance of 56 billion, translates into a NIM of 109 billion rupees versus 115 billion reported for corresponding period last year. If I can just quickly take you through the spread analysis. In terms of earning assets, gross advances an average base of 717 billion at a yield of 10.88 versus 600 billion. So gross advances volume is up by 117 billion. However, there is a drop in yield of 727 basis points. Resultantly, the gross markup income advances is down by 23, much of it coming in on account of the price variance to the tune of 39 billion, offset to the extent of approximately 16 billion on account of volume variance. On the investment front, an average volume increase of 333 billion, decrease in yield of 678 basis points. So resultantly, the gross markup income investments was down by 36 billion rupees. On the liability side, we reported an average base of 2.082 trillion versus 1.8. So the total deposit base has grown by approximately 200 billion. Approximately 184 out of this 200 is coming out of the current account side. So on an average, we have improved our current account concentration from 47% reported as of September 30th, 2024 to 51% as of September 30th, 2025. However, the effect of monetary easing reflects on the spreads of the bank. Thereby, the spread recorded a reduction from 6.58 for corresponding period last year to 5.16 for the current year. Now coming back to the profit and loss account, so non-interest income of 26 billion rupees, primarily flattish. Prime areas where this increase was dividend and FX income. However, the fee was where we faced a major dent, and one particular revenue, which is the intense competition on the remittances side. So there was a negative. Obviously, we wanted to channel more remittances to our network, and for that, based on the market dynamics, the fee has to be passed on to the tie-ups. In terms of non-markup expense, 52.89 billion paise, increase of 6.34 on the operating expenses side. This increase of 14.6 was primarily driven by investments in talent, technology, and marketing. However, the cost-to-income ratio for the bank works out at a decent 37.65. Our short-term cost-to-income target is set at 35% going forward. In terms of credit loss allowance, based on the recoveries posted by our recovery units, plus the reduction in the gross advances base, which resulted in a reversal of PCS charge of stage 1, we reported a reversal of 5.45 versus a charge of 0.86 billion for corresponding period last year. This takes our profit before tax to 87.48 versus 95 billion reported for the period 2024, 9-month period 2024. In terms of taxation, there was an amendment made in the tail end of 2024, where the corporate tax rate for the banking companies was revised upward, and the ADR taxation was done with. So the corresponding period taxation effective tax rate is 49. However, for this year, the effective tax rate based on the revision that I just covered scales to 53%. So resultantly, your profit after tax for 9 months on a standalone basis is 41.1 billion versus 48.5, which reflects a reduction of 50.2%. So having said that, this anomaly with reference to effective tax rate would be adjusted in the fourth quarter results, as the entire differential of the change in rate was accounted for in the fourth quarter of 2024. In terms of profitability ratios based on the performance of 9 months, ROE comes to 23.5, ROA comes to 1.85%. With reference to CAR, no concerns there. Significant buffer on top of the regulatory requirement of 11.5. So CAR is at 19.88, which was 19.35 as of December 31st, 2024. Leverage ratio well above the regulatory requirement of 3% at 5.72. Liquidity coverage of 267 and net stable funding ratio of 163 against the benchmark set of 100%. Now, snapshot of our wholly owned subsidiary MCB Slavic. So the effect of MDR application from 1st of January reflects in the performance numbers of MCB Slavic, as is the case with all the Islamic banking institutions or operating in the country. So we do observe a drop in their profit before tax number of 45%. They made 3.6 billion versus 6.6 billion made for corresponding period last year. However, with the sizable scale that we have in terms of branch network, scaled up to 3 or 5 branches as of September 30th, 2025, and with all the bells and whistles, and by that I'm referring to all the offerings on the digital front in play, we expect this Islamic contribution to be a bit better in the times to follow. So from our next quarter onwards, we expect the current account mobilization, particularly on the Islamic side, to be more robust and strengthening our total group-wise current account number. Sums up the presentation on my side. Over to you, sir, for the Q&A. Thank you.
Thank you so much, Hamad, for that comprehensive presentation. Ladies, a question to ask, you can either raise your hand or type in your questions in the chat box. But before you do that, may I request the participants to reflect their company or institution name, please. So we do have a couple of questions in the chat box. The first is from Atlas AMC. Right. From Talha. He's asking, what is your current account percentage target for 2026?
Well, the guidance that we gave to the market was 55% for the short term. We have achieved that target, and we want to build up on this particular side. So the challenge for us is that we want to continue growing our deposit base in totality. Having said that, we have shied away from the high cost deposit number. So it's pretty easy to buy out your market shares. You just offer a special rate out there and you can just grow your deposits like that. But it is dependent on what you expect in terms of interest rate outlook, and then you decide your strategy accordingly. So for us, I believe we will be scaling up our share. We would like to see it reaching 60 in the near future. The strategy, as I shared earlier, is in play, and hopefully that in the next 2-year period, you would see us scaling a 60% concentration level on the current account side, inshallah.
Perfect. And second question is on the weighted average yield on fixed portfolio, the investment book.
On the fixed rate PIB, the weighted average yield of the outstanding stock is close to 12.29%.
Okay, thank you. So a couple of questions from Murtaza Hussain from Sona Corp. He's asking, can you give guidance on, again, he's asked on current account target for 25-26, but then again, there's also deposit growth target for next year. And what is the average spread on T-bills on floaters and average maturity of the floating rate portfolio?
Well, with the reference to our total deposit target, we are eyeing north of 20% for the upcoming year. We are close to 16.3, 16.8 for the current year as we speak, and there would be some strong deposit build-up in the last quarter of this calendar year as well. So the target is north of 20% for the upcoming year. So on the spread side, obviously it depends on what are you mapping with. So in terms of cost of fund, as I shared, it's 5.01 for the domestic franchise. You can just easily do the maths. If a treasury bill for 1 year tenure is yielding at around 11.03 or 11.3%, the spread that you make on the basis of total cost of fund would be close to 6%. However, if you actually map it with a saving account generation for which there is an MDR application of 9.5%, you need to plug in the CRR cost of 6%, which takes the total cost to close to 10.2. So for that, if we map it with the saving deposits, the total spread on a treasury bill would be limited to 80 basis points approximately.
Got it. His next question is on the floating rate PIBs. He's asking if they've been reset in 3Q 2025.
Majority of the portfolio is reset. However, since we are active in the market, obviously there are certain tranches would be repriced in the times that follow, but we don't expect a significant impact on the net interest margins as we thread ahead for the fourth quarter in terms of repricing of investments.
Got it. A couple more questions that he has. He's asking about the remittance income and what sort of growth you're expecting for CY26, followed up by your cost to income target for 2025 and 2026.
Well, on the remittance side, I believe with some change in the regulation that was introduced somewhere in June, July, where the marketing incentive was done away with by the Central Bank of Pakistan. Now, we believe that some sanity would prevail, and the intensified competition that we have observed on the remittance side would be normalized in the times to come. So it's not only limited to MCB. I can safely tell you that the entire industry has recorded significant expenses or reduction in income in terms of the remittance channel. For us, it's, I believe, minus 3 point something billion rupees for the remittance side alone. So going ahead, we expect this situation to normalize, and we would never want it to be a negative number. If we are able to channel the remittance flows that we carry as of now, around 12% share on the remittances side, which is approximately $4 billion plus, we expect decent contribution coming in from the remittance side. I can't quote an exact number, but if the market remains a bit competitive, obviously it would take its impact on the remittance income number as well.
Perfect. We have a raised hand from Mr. Suleiman Mania. Suleiman, you can go ahead and unmute yourself and ask your question.
Hi. Thank you, Intermarket, for holding this. Thank you, MCB Hamad Bhai, for your presentation. What I want to ask you, Hamad Bhai, is like what is the competition which MCB Islamic is looking out in the Islamic banking space? And also, there is going to be a big transition in the Islamic banking space over the next few years at Mizan Bank, right? So, where should we as investors look at how MCB Islamic is going to go through this space? Where do you see this the Islamic Bank to be over the next 3 years in the entire space? Thank you.
Thank you, Suleiman, for the question. So for our Islamic franchise, you would observe that we have been operationally building up the capacity. So previously we were close to 150 odd branches. That's not too long ago, but we have scaled up the operational network to 3 or 5 branches, and there is a plan to add more to the brick and mortar channel. Apart from that, as I shared in the presentation, we were operating on a different digital platform. We have very recently upgraded ourselves to OBDX platform. With digital account opening coming into play, we expect some decent traction on the new-to-bank relationships on the MCB Islamic side. So with reference to your question on the competition, currently, I believe if we look at the Islamic banks in particular, I'm not talking about the Islamic banking division of a big conventional bank. If we look at the Islamic banks, the competition isn't there. It's Mizan Bank, and next to it, I believe I would rate all the other banks operating in a similar kind of a territory. So that provides us the comfort, that provides us the strength to actually get into that league. We would want to be ranked as second or third in terms of Islamic banking entities, particularly in the next 3 years that come our way. So as I said, the growth that we see on the balance sheet side hasn't been that phenomenal for our Islamic banking franchise, but with the right tools that we have for the Islamic banking in subsidiary, we are hopeful that you will see a better contribution coming into the group results from this franchise.
So 2 questions. I just got a car from MCB Islamic at K plus 1%. So I was just wondering, I mean, till what level will these Islamic banks actually compete till in these auto loans? And when you talk about growth, obviously we have to understand that MDR was recently applicable on Islamic banks, right? So that has obviously eroded profitability by a certain number. Underlying growth still happens to be quite strong, if I'm not wrong.
Yes, it is. So coming back to your first question, I believe the appetite for the consumer banking growth is there. You would have observed a similar kind of attraction for MCB numbers. We were able to add approximately 18-19% of to our portfolio on the consumer lending side, and much of it is tilted towards the auto financial segment. So similar situation in play for MCB Islamic and Islamic Ijara financing. So with reference to the growth that you see, I do understand that the performance numbers don't reflect pretty good for the small Islamic banks. It's a drop of around 40% on average across the industry for the 9 months period. The impact of MDR would be diluted, obviously, when we are able to capitalize of work more on the current account side. That remains the name of the game on a group wide as far as MCB is concerned. So hopefully you would see better performance numbers in the next quarter when we close the year end. You'll see a decent contribution coming in from the Islamic banking franchise.
The last question. Can we see some M&A activity from MCB Islamic to enhance the portfolio? And best of luck for the future.
Sulaiman is always on the cards. We are always on a lookout. Anything that makes financial sense to us that falls within the risk appetite that we have for ourselves, we will always go ahead with it. And thank you for the wishes.
Thank you, Suleiman. So our next question is from, it's a follow-up from Waleed Rathore. He's asking if there's any further repricing expected in Q4. And there's another question linked by Wasim from NBP Funds. He's asking how much of the fixed portfolio is expected to mature in 2026?
Well, no significant maturity as far as the fixed rate portfolio is concerned in the immediate 6 months or so. So there would be some maturities due, but it would not impact the total book significantly. On the floater side, as I covered, it's a dynamic process. Obviously, when you carry a base of 1.2 trillion floaters, obviously something would come into play in terms of repricing, but the impact of that is not significant for the fourth quarter. So I can safely say that almost, not almost, but majority floaters have been repriced as we speak today. And we don't expect any NIM compression on account of the repricing of the outstanding floaters that we have in the book as of 30th September.
Right. We have a question from Fiza. I understand you covered this in your presentation. She's asking what is the yield on fixed rate PIBs? I think the rest you've already answered.
Yeah, the fixed rate PIB yield is 12.29 on the outstanding stock.
Hamad, I think your voice isn't coming through.
Were you able to hear me?
Yeah, can you repeat?
Okay.
Sorry, thank you.
So the fixed rate PIB yield is 12.29%.
Perfect, thank you. We have a couple of questions from Mohammed Mushtaq. He's asking, could you please share how many CDM machines MCB Bank currently operates? And among the new branches, Islamic, and how many will be conventional?
Sorry, can you repeat the questions? Second part of the question, Yusra.
Regarding the new branches that you're going to be opening, he wants to segregate them, if you could, between Islamic and conventional, the new branches that you're not looking to open.
Okay, so Mustaq Sahab, thank you for your question. So responding to your first question, currently we don't have any operational CDM. It is in the process of deployment as we speak. Just to bring the forum on board, we are in the process of outsourcing our ATM and card management system to Euronet. And the prime reason for that is the agility, flexibility, and time to market. We want to gain on these three particular aspects, and hopefully this transition would be completed within this calendar year. So we will be rolling out the CDMs. We understand there is a regulatory mandate assigned to all the banks to have 25% of the total branch strength ATMs deployed by June 30th, 2028. So that's part of our strategy, and you will see that coming into play by identifying key areas where we see that a CDM deployment would serve the purpose more. With reference to your second question, we being MCB operating a wholly owned Islamic subsidiary, the branch expansion plan that I shared of 40 plus branches would be all conventional in nature. Our subsidiary would be eyeing opening Islamic banking branches, and I believe the plan there is to add another 10 to 15 branches in the upcoming year.
Thank you for that comprehensive response, Ahmad. So we have a question from Mustafa Mustansir from Taurus Securities. He's asking if you could share the strategy for the growth in current accounts. I understand this is a popular question in the context of such impressive current account growth during the current year.
So thank you for the question, Mustafa, but I believe it's a blend of everything coming into play. So first and foremost, I would tag it or associate it with service quality. So there is a lot of focus on the service quality improvement. There were a lot of concerns that were voiced by our customers, and we have been actively working day in, day out to make sure that we improve our service quality levels. By virtue of an introduction of a scheme as well, which rewards our operational staff if we are able to reduce the number of complaints associated with that particular regime, or reducing the TAT for opening of an account. So these are things that which are in play. Apart from that, as I shared in the presentation, we are working on deepening the existing relationships. We have a huge customer base which is keeping balances as low as 10,000 rupees with us. So with some direct engagement from the field formations, we have been able to get some traction on it. There is some decent work done on dormant activation. So a huge population of our total customer base is in dormant, and they do keep some balances with us, and we are trying to actually activate that relationship and make sure that we are able to deepen it further. Other than that, one thing which has worked well for us is the remittance portion. So when we channel close to 4 billion rupees, $4 billion every year, we just converted at 280, that's close to 1.2 trillion worth of deposits flowing through your channel. So what we are doing is we are trying to capitalize on this remittance flow, working on the beneficiary side, and make sure that we activate deposit relationship with the beneficiaries here. Lastly, there has been an incentive scheme that has worked well for MCB, where we reward the field formation for the current account mobilization within the quarter. So there have been schemes throughout the year, and I can tell you that there has been some decent traction on the current account side. And obviously, it's all tilted towards averages. So we are focused on building current account averages rather than looking at the period numbers. Lastly, I believe it has to do more with the feet on street. So we are beefing up our retail franchise. We would be adding further strength to our retail franchise front-end staff in the quarters that follow, and then the number would be massive. I believe we are eyeing close to addition of 3,000 to 4,000 staff, which will be solely working on the deposit mobilization side.
Thank you so much for that, Hamad. So we have a question follow-up from Waleed Rathor. He's asking, can you kindly repeat average yield on floating PIBs?
Average yield on floating PIBs is close to 12.14.
Thank you. We have a question from Saklan Paracha from ARN Financials. He's asking, can we expect the IPO of MCB Islamic?
Well, this thing has been a kind of a constant question for the last many calls, I would say. As I shared earlier, it's in review. It's being discussed at an appropriate level. But I believe for an IPO, there has to be some performance number reflected as well from the particular entity. So I won't say that there is a timeline tag to it. We are constantly evaluating the situation. And whenever the management or the board feels that this is an appropriate time to proceed with it, we will do that. Or we will be guiding the market accordingly, inshallah, on this.
Great, thank you. We don't have any further questions on the chat box, so I'll refer to the ones that we've received by email. So regarding the remittance business now, I understand that there have been some relaxations and rollbacks on the incentive scheme. So what is now the guidance there?
Well, Mr. I believe the intense competition that we were facing in the last few quarters has to an extent normalized. It has not gone away altogether, but normalized levels. Just to bring the forum on board, there used to be a marketing incentive scaling from 1 rupee to 2 rupee for every dollar that a particular bank would bring in through its tie-up. And it would be a function of how much growth you registered over the last fiscal year. So for the sake of instance, if you're growing your flows by 10%, you get $1 per rupee. If you grow it by 15%, you get 2 rupees per dollar. But that scheme was in play for the last 2 years. It's done with as of 30th of June 2025. Now it's 20 reals for every $200 transaction that is channeled through a particular bank. So obviously we do understand that FX has been a cause of concern, and every big player is actually going all out in this particular market to ensure that the flow is channeled through its own network. So post June 30th, 2025, we have seen it normalizing a bit. Obviously, when you actually reach a tie-up along with your competition, the ask from the tie-up would be if it is being offered 1.5 rupees to a dollar, we would have to pay 2.5 or 2 rupees to a dollar to channel it through our network. So that competition is actually slowing down. I believe a lot of hit has been taken by almost all the major players in the remittance flows, and we expect it to rationalize in the times. So we want to see, and I hope when we see a green number coming in from the home remittances side. By that, I'm referring to the income number there. Currently, it's a red. It's something that we or the banks are paying out of their own pockets to channel more remittance flows.
Thank you for that. Another question is on loan growth. So what sort of growth can we now expect, particularly in the consumer segment and the corporate SME, since there has, of course, then there's been some rollbacks there. And what is now the recovery pipeline looking like in terms of asset quality?
Well, on the loan side, I believe it would be a muted kind of growth for the upcoming year. However, if we look at the segments, as you pointed out, consumer, we expect consumer to perform better than the remainder segment, that is the SME part or the corporate part. And the main issue is that we have been reiterating that advances remain a mainstream business line for us. It opens up avenues for cross-sell for the bank. However, there is a very limited pool of good quality assets out there. And obviously, we won't take exposure on anything that does not fall within the risk appetite that we have defined. So on the consumer side, we expect the growth that we have reported for the 9 month period to continue. On the interest rate side, I'd call it that there is a period of pause. We don't expect the interest rate to move in the next 6 months or so. It would remain at similar levels. So having said that, on the NPL side, we don't expect any accretion, significant accretion in our NPL base. A lot of it has already been objectively or subjectively classified in the books. However, I won't rule out any small additions to the NPLs as it remains a BAU.
Thank you, sir. And just a final question is basically on the NII, given your outlook for interest rates, so where do you see the growth now, or do you expect a trimming in 2026?
Well, two specific dimensions to this. One is that I believe much of the impact of the monetary easing is already reflected in net interest margins. And while we continue to build up on the no-cost current account mobilization, I'm fairly confident that you would see the net interest margins improving with the passage of time. Secondly, a few quarters back on the saving account side, there was a serious negative carry. If you plug in the CRR cost and the MDR, there was a negative carry versus the treasury bills. It has now converted into a positive. It's a green now, but not very significant. However, it depends how the yields move as we thread ahead. We have seen a 1 year treasury bill auctioned at 11.35 yesterday. That's almost 90 basis points higher than what it used to be a couple of months back. So that is actually providing some room to focus more on the saving account side as well. But again, we would be focusing on the rack rates. We are not into the play of offering high or special rates or soliciting high cost deposits. We have a huge base of 960 billion as of 30th of September in terms of saving accounts. And it's the entire local saving currency is at rack rates, not even a single rupee of special deposits offered there.
Got it. Thank you so much, Hamad. And given that we are nearly 40 minutes past the start time, I think we can conclude the call. Thank you so much. And thank you so much, everyone, for joining. Hamad, if you would have any concluding remarks, please go ahead.
So first of all, thank you everyone for your interest in MCB Bank Limited. But I can assure you that we have a clear strategy chalked out for us. The focus would remain to capitalize on our key strengths. And our key strengths, as we have been reiterating, have been low or no cost deposit mobilization, ensuring that our asset quality remains the check, and we keep a tab on our operating expenses. So we would continue to focus on these particular areas, while the digital transformation remains in full swing, which is going to aid our retail business as we thread ahead. So we are very hopeful that we would continue to deliver the exceptional results that we have been doing over the last few quarters, and we expect to build up on the momentum that we have gained in this year, particularly in terms of current account mobilization. Thank you.
Thank you, Hamad. With that, ladies and gentlemen, we would like to conclude the call. Thank you so much, everyone, for joining the presentation, and thank you so much, Hamad, for taking the time. I'll see you
Thank
next time, inshallah.
Thank you.
Recording stopped.
Thank you, everyone.